All right, let's jump right into our next segment, which features government's perspective on DIPAM's corporate composite strategy. First up, please join me in welcoming the session moderator, Mr. Utpal Sheth, co-chair, FICCI Capital Markets Committee, founder and mentor at Trust Group. So we welcome you on stage, sir. I'll also request Mr. Sunil Sangai, Chairman, FICCI Capital Markets Committee, founder and CEO at Nova One Capital, to please join us. And for this special keynote address, ladies and gentlemen, we are honored to be joined by the session chief guest, Dr. Arunish Chawla, Secretary, DIPAM, Ministry of Finance. Gentlemen, may I request you to please join us on stage? Yes, please, sir. Ladies and gentlemen, let's give up for this fantastic panel that will be coming up next. Thank you, sir. With that, I will request Mr. Sunil Sangai to welcome Dr. Chawla and present a green souvenir. Our token of appreciation to Sir for joining us here in this edition of CAPM. I'll now request Mr. Utpal Sheth to introduce Dr. Chawla and moderate the session. Over to you, sir.
Good afternoon, friends. It's my pleasure and privilege to interact with Dr. Arunish Chawla today. And he brings tremendous knowledge and wisdom along with him. He's an IAS 1992 batch and also a PhD in economics from London School of Economics. Dr. Chawla currently serves as the Secretary, Department of Investments and Public Asset Management, DIPAM, which is part of Ministry of Finance since January 2025. Earlier, he held the charge of 3 departments, which is DIPAM, DPE, Department of Public Enterprises, and Ministry of Culture. As Secretary DIPAM, he is responsible for managing Government of India's equity in public sector enterprises, including capital management, dividend distribution, divestment, and value creation. He's held many significant positions in the Union government in the past. He worked as Joint Secretary, Ministry of Finance from 2014 to 16. During 2009 to 14, he served as Executive Assistant to the Vice Chairman Planning Commission, Shri Montek Singh Ahluwalia. It's my pleasure and privilege to be on this panel along with him and Mr. Sunil Sangai. Thank you.
Good afternoon, friends. It's not easy to be Secretary Disinvestment and stand up and speak in a public forum. I thought let's use this opportunity to understand, to explain the history of disinvestment strategy and also how the policy, the strategy has evolved over the last 25, 30 years. I'm aware I'm standing in the land of Bollywood, but economic policy is neither glamorous nor flamboyant. It is difficult, systemic, hard work, and it evolves with continuity. Friends, I'll start by taking you down the memory lane and explain the history, our economic history, how the investment or disinvestment strategy evolved and how it has changed over the years. The Department of Disinvestment was founded in 1999, and the first 5 years we can describe as the first phase, which was more like a pilot experiment phase, where for the first time we were dabbling into a very difficult area, a very complex area. And that is when the philosophy, the strategy, the processes began to evolve. It was not entirely smooth. There were, difficulties along the way. But the good thing is that post-liberalization, this was a natural thing for our country to take up and to enhance the productive capacity of the economy. And a lot of good work was done with a lot of zeal, a lot of risk-taking and even bravery in that first initial phase. And about 12 enterprises were disinvested, privatized, and about 20 hotels were, leased out to the private entrepreneurs through snap sales. The next phase, I would describe the phase between 2005 and 2015, when the whole thing had to be dealt with very carefully in an environment of coalition government where political constraints were veritable and they were a matter of concern. And in that stage, even though the strategic disinvestment was put on the back burner, the minority stake sales, offer for sales are continued. The overall pace, of course, given the political constraints, slowed down. 2015 onwards, we can classify this as the third phase, when a more composite or an evolved value creation strategy evolved. It did not evolve overnight through the waving of a magic band, but it evolved as part of a conscious strategy, which was perfected, processes which evolved over the last 15 to 20 years. And today, we are happy to announce that the government has adopted a very composite value creation strategy. The vision of our Honorable Prime Minister and our Finance Minister is that we should share the wealth of public enterprises with common people. And that is why the new name of the department is not Department of Disinvestment, it is DIPAM. हमारा काम है दीप जलाना और छोटे इन्वेस्टर्स, माइनॉरिटी स्टेक होल्डर्स की ज़िंदगी में रोशनी लाना. And that is why the department is now called the Department of Investment and Public Asset Management. And today, we manage assets or public assets in a truly integrated fashion. And that is the composite strategy which I would detail out today. As you know, in 2021, a new public enterprise policy was announced. And as part of this policy, it was very clearly envisaged that both public and private sector should thrive, they should be partners in arms, and they should partake in the development and the growth story of our great nation. The composite strategy clearly spells out and understands that there will be certain areas which will be strategic, where public goods have to be delivered, where a few critical public services, including social services, will have to be delivered for the inclusive part of the growth story, where certain areas would be linked to national security and defense, where public sector will have to take a lead, And last but not the least, as we enter an age of global value chains, certain critical inputs, certain critical raw materials, certain critical intermediaries, which keep our value chains and the private part of our economy going, they will have to be led or taken care of with the involvement of the public sector. At the same time, there are huge areas where the private enterprise can flourish, where greater private participation is desirable for the inherent strength of the economy and for propelling us forward into the new age. As part of the strategy, we have listed a greater number of public enterprises. Today, the best of public enterprises, about 70 of them, are listed on the stock markets. They share their stocks, their wealth with minority stakeholders, ordinary investors. And today, they are not a small part of our stock market. The public enterprises together account for 15% of the market cap. And our market cap today is very big. We are now the fourth largest stock market. Already we touched a 5 trillion market cap last month. And the last, because we track this, it's our job to track this on a daily basis. You will be very happy and thrilled to know that now we have 20 crore demat accounts in our country. So you can imagine in a country of 30 crore households, very soon, not just the Prime Minister's Jan Dhan dream of having a bank account, a financial inclusion, but we are moving towards an age where almost every household will partake in our stock markets, in our capital markets. That is a huge achievement. Friends, the composite strategy that I'm talking about rests on 4 pillars. And these 4 pillars are corporate performance, the CapEx or the sustained CapEx, sustained capital investment, a fair dividend policy, and calibrated disinvestment. I'll take each one of them by turn. Corporate performance, today, all public enterprises, which are about 175 of them operational, about 70 listed, another 100 smaller ones unlisted, they all have to undergo an annual corporate performance evaluation, which is called the MOU framework. And as part of that strategy, there are consequences. The pay, perks, and of the leadership, corporate leadership, is linked to performance, almost like the private sector. The process of appointment at the highest level has been cleaned up, and today, the corporate leaders in the public sector are some of the best in the world. And when they hang their boots, many of them are hired by the private sector in equally important and performance-oriented positions. The second part of the strategy is sustained capital investment. And as you know, as the geopolitical headwinds become stronger, our government has adopted a balanced approach to growth and a balanced policy strategy to support each part of our economy. A very significant part of that is the public sector capital expenditure, of which about 12 lakh crores this year will come from the central budget, an equivalent amount from the state budgets, and another about 8 lakh crores will come from the public enterprises and the public bodies, which is called IEBR, the internal and extra budgetary resources. I'm happy to stand here and announce that we just finalized the first quarter results, and we found that we've already achieved 25% of the capex target through the budgetary resources this year. And for the public enterprises, we have data up to the end of July, and we have already achieved 29% of the target this year. The third pillar of this strategy, which we call as fair dividends, is a very important element of this strategy, which, as I mentioned, shares the wealth of our public enterprises with the citizens and the common investors. And as you know, dividend policy is a difficult part of the capital markets, with points of view on both sides of the aisle. And the difference is largely because whether you approach it from the lens of a trader or you approach it from the lens of an investor. It's a bit like the monetary policy, where discretion versus rule, or what is called time consistency, matters. Because that is what makes capital markets, and particularly the saving investment side of the small investors, more sustainable. As part of the fair dividend strategy, our government has a very simple rule or simple formula for public enterprises, which is the way we prepare our corporate statements and the way we prepare our top lines, bottom lines, we pay our taxes. In the same way, we should regularly, honestly, in a transparent manner, share the dividends with our shareholders. And the formula is very simple. For those of you who know the literature, the fair dividends could be somewhere between 30 to 50%, depending on the stage of the economic cycle or at what stage of the firms or corporate you are presently located. So we have, there are, of course, firms which like to accumulate reserves and maybe not immediately invest them. So as you know, dividends is in the hands of the investor. The retained profits are in the hands of the promoter. So to strike a fair balance between the two, we have set 30% of PAT or 4% of net worth, whichever is higher, as the rule for public enterprises to make them role models in the capital market. And this has helped, one, it has helped distribute dividend incomes timely, regularly, which acts as the secondary income in the economy and keeps the consumption and the savings investment engine going. And I'm happy to announce that as part of this strategy, we have consistently paid higher and higher dividends from public enterprises to small investors every year. We paid the highest ever dividends last year of around 1.2 lakh crores. And we hope to sustain the same momentum and even exceed it this year. We are also looking at another systemic change, which is don't wait till the end of the year. In the same way as you make quarterly statements and accounts for listed firms and file them with the stock markets, you file your taxes. In the same way, at the same thing, as a matter of habit, pay interim dividends every quarter. And we are going to actually lead by example and put it into practice this year. These instructions have already been given to the public enterprises, and they are on the job, and they hopefully will deliver even better results this year. want to make public enterprises part of every Indian's portfolio. And with this strategy, they have now almost become hedge stocks, which means even when the markets go down, the public enterprises will be there to stand by you, to create value, and to give you sustained dividend incomes. Friends, the last pillar of this strategy is calibrated disinvestment. And calibrated disinvestment means we adopt a mix of strategies which include offer for sales, which include initial public offerings, follow-on public offerings, which includes buyback, as my friend just explained, and last but not the least, strategic disinvestment. As part of this strategy, in the last 10 years, around 200 transactions have been carried out. Many more will be carried out this year. About 20 disinvestments, strategic disinvestments have already been completed. 8 more are in the pipeline. And the second or the flip side of the coin, which is closure and which is often forgotten, is also equally significant. About 24 enterprises have been closed down in non-strategic areas to make greater way for the private sector. So disinvestment, my friends, is not just sell. It is also closure and make greater space for the private sector. And the two must be seen together with the same lens, because even though at a micro level they appear different, in general equilibrium they achieve exactly the same things, which is to enable private sector to partake in the economy, have greater space to grow, and propel the economy forward. My friends, thank you very much for inviting me at this annual capital market event, and that too, as I said, in the financial capital of the country, where all the capital markets are operated and they thrive. And my best wishes to my hosts, to FICCI, to my friends, to all the familiar faces that I see in the crowd. Many of us work together for the same aim, which is to make India great. Thank you.
Thank you, Dr. Chawla. That was so refreshing to hear about value creation in public sector enterprises. Very few public sector enterprises globally think of value creation. And to do it in such a thoughtful and nuanced manner, I must really compliment you, sir, and your team for all the good work that you have done. Just to share one piece of information with you, since March 2020, the CAGR of the BSE PSU index has been 38%. I think it has significantly outperformed the rest of the private sector IRRs. So again, compliments to DIPAM and to Dr. Chopra. So, Dr. Chawla, so my first question to you, sir, would be, in addition to all the good work that you've been doing, the National Asset Monetization Pipeline is also a fantastic initiative. And it will help if you could throw light on that, because that is the lesser known aspect of DIPAM.
Thank you, my friend. As you very rightly said, the asset monetization pipeline is a second important aspect of the asset management strategy. And it essentially means that we put idle public assets to productive use. Very often people confuse this with actual sale of public assets. As you know, Those who know national accounts, the sale of land does not become part of the GDP. That's an economic fact. What becomes part of the GDP is the value you add. That is why it is called gross value added. So essentially, the point to remember and to understand is that many public enterprises, many public bodies, many public departments, many government authorities have assets which could be put to better productive use, and putting them into better productive use is asset monetization. Of course, it also gets some revenues for the government, and what I did not mention and what is that now in the composite strategy, we look at them together. So when we say there is a asset monetization or a disinvestment target this year, it essentially means there is an asset monetization target. And say, for example, against a target of 47,000 crores, by the time first quarter results came in, we've already achieved 20,000 crores. So which includes both monetization of financial assets and non-financial assets, including InvITs, including the railway assets, the power grid assets, the highways assets, and the idle assets of public enterprises which are now being redeployed to more productive use. We set an ambitious target of in the next 5 years, and it has been fairly divided between different verticals in the government, different departments, different authorities, agencies, and very rightly, along with the composite strategy on financial asset management and the asset monetization pipeline will support all sectors of the economy and propel it forward.
Thank you, Dr. Chawla. On the disinvestment and strategic sale aspect, as you mentioned, you've already done a lot of transactions. Some of the transactions have taken a lot of time, I'm sure due to multiple reasons. But going forward, if there is any sectoral focus or prioritization to that, it'll be great if you could share that.
I would say the efforts are diversified across sectors. So, and these are complex, very complex transactions, so they have to be handled very carefully and in a very fair and transparent manner. As is well known, IDBI Bank is under a due diligence process. The qualified parties are almost completing their due diligence as part of the exercise. In addition to that, there are units in almost every sector, including heavy engineering, including pharmaceuticals, including engineering, and so on and so forth. And at the same time, as I mentioned, there are also units which we have taken up for closure because we think that is an area where government need not be in business, but private sector should have a greater opportunity to grow.
Right. Thank you for that. With regard to investor access, again, I think DIPAM has taken many initiatives and innovative steps, like the CPSE ETF and Bharat ETFs. If you could elaborate on your strategy going ahead with regard to such ETFs and how that will play a part in your overall DIPAM plan.
Let me share a few data nuggets with you at this moment. Almost 5 lakh crores of financial asset monetization or 5 lakh crores has been done as part of the disinvestment strategy in the last few years, of which ETF is also an important part. But over the years, we realized that an ETF strategy was not getting us a fair value because we were mixing up the good performing stocks with the not so good performing stocks. And therefore, now we have, a more focused offer for sale or QIP or FPO strategy, where we keep a larger number of stocks in our basket and look for market opportunities in consultation with many of our partners who are sitting here. And, of course, these transactions are confidential. Those details cannot be given here, but you will keep hearing them during the course of the year as the time comes.
Sure. Thank you for sharing that. The strong emphasis on transparency and governance that we are seeing in the PSU companies is a big change from what it used to be. And clearly that has resulted in the change in multiples. But it is also resulting in a greater consciousness with regard to cash flows, ROEs, and so on. And maybe some of them are also driven by the dividend imperatives. But this consciousness of efficiency and optimization across all public sector enterprises that we have been seeing in recent years is clearly demonstrating that the role of public sector enterprises in a fast-growing country like ours can be much more. The 15% number, sir, that you mentioned at the beginning, in your from your point of view, how does that pan out in coming years?
When I said 15%, it was 15% of the market cap. And we must always remember that we are a very big capital market. And if you compare it to the size of the economy, we are already 130%. And some of the big countries, including our competitors, horizontal competitors, I would not like to name, but they're actually behind us if you look at this metric. Even though in absolute terms, their capital market may be larger.
That's the market cap to GDP ratio. Yeah.
Exactly. The point I was driving at was, if you see the share of public enterprises as dividends paid to the total dividends paid in the stock market, in our capital markets, it is much higher than 15%. It is as high as 25%. And recently, when we did this in-house applied research, we found that the public enterprises over the last 5 years, both first and second orders stochastically dominate the corresponding private stocks. And that's because of this conscious fair dividend policy, which we don't leave now to discretion. But, and as I explained, why, having a rule-based framework is better when you're dealing with capital markets which are inherently uncertain. And that has given us very good results. And the composite strategy hasn't evolved overnight, because in this 25 years, 30 years journey, we realized that all elements of this performance, not just market performance, but corporate performance, the corporate value chains, both top lines, bottom lines, savings investment, capital investment, they're all very important elements of our overall growth strategy. And when you look at growth numbers, we should not be obsessed with isolated numbers. We are in a growth convergence phase. What we should be looking at is how fast we are moving on the highway of growth convergence and how we are growing vis-a-vis the global average, and whether our growth is inclusive in terms of alleviation of poverty. And our public enterprises are a role model in all these dimensions, and I must use the opportunity to congratulate them for what they have achieved. Thank you.
Sir, if I can interject, ask one question. See, as you rightly articulated, the policy has evolved over a period of time, and public sector enterprises is an important part of our economy given the construct of our country, and it should be that way, and therefore the policy framework has to be well thought out. We have tried various models. We had one way of just the listing. We have also looked at board controlled model. We looked at disinvestment privatization. We looked at strategic sale. We looked at sale through the capital market, through the asset monetization. You talked about REITs and MITs, which is quite popular. And the balance approach cutting across the entire platform is definitely something which will suit better for our country. And I compliments to you and your team for actually putting that together. However, there was an announcement as a part of Atmanirbhar Bharat. At that time, the certain policy statements were being made. One of them, if I recollect, said the government needs to be in every strategic sector, one or two enterprises, and then they would exit from the other. Non-strategic, the government will exit completely. Does that still form part of this balanced approach, or is there any change in the thinking there?
Yes, very much. It is an integral part of this balanced approach. And if we look at how we have moved forward, almost 30 enterprises have been closed or in an advanced stage of closure. And this year again, we are doing a review where we will look at the remaining public enterprises, the unlisted ones, and the ones which are in the non-strategic sectors, and again think and analyze how far we have reached, and from here on, what we need to close, what we need to list, what we need to merge, what we can strategically disinvest, and so on and so forth. And this, and you know, very recently we have strategically disinvested one joint venture of ITDC. 2 more are in the pipeline. So that process of, you know, revisiting, cleaning up, re-energizing is ongoing, and we have also started another review, another round of review this year.
One more add-on I'm stealing from Utpal.
Agree for more.
Yeah. Sir, this balanced approach, and then as you said that there are different approaches which are being taken. One thing, just purely from the capital markets perspective, and no one better than Utpal would know, and some of known faces of yours who actually deal in the capital market day in, day out will tell you that there is enough liquidity in the market right now, both in terms of debt and equity. So across the asset classes, whether you want to do equity sell down, or you want to do something like REITs and bits where you monetize the asset. There was a discussion at one point of time, the land monetization, so different kind of asset monetization. From the capital market, we reassure you there is enough liquidity. In fact, as you rightly mentioned, hungry for more, the capital market is hungry for more. So if you put more stock and more asset in the market, market will absorb it.
Point well taken. And, since we are all here sharing good news and in a happy mood, I'm so happy to say this, that when the geopolitical headwinds come and the FIIs begin to move out, FIIs, fickle institutional investors, the DIIs come in, and DII stands for devoted institutional investors. So congratulations to all of you here, and we've been partners in arms. And if you watch, for those like all of us who watch the markets on a daily basis, the way DIIs have come in during this period is very, very impressive. And in fact, they have exceeded at times when the FII in the debt markets, which is also a very happy development because that completes the asset class. And it is even happier to note that SIPs have picked up in such a systematic way. And today, 25,000 crores, which is almost $3 billion of SIPs are invested in our capital markets every month. And believe me, a phenomenal change and democratization has come in the market. It is not just Dalal Street anymore. Ordinary Indians, ordinary households. I was shocked to learn one day that one of my simplest and the most junior-most and the most honorable staff, he was also holding a SIP and investing his small hard-earned money every month. It's such a touching story. And it's happening all over the country now. As I said, 20 crores demat accounts we have opened in our country, which is almost 2/3 of our households. And when I speak to vernacular or media, believe me, the viewers come from the heartland, from small towns, and they're the ones asking maximum questions, and they're the ones who are now part of this dream. Thank you.
Thank you for that, sir. My last question is, DIPAM is driving capital efficiency at an economy level, and at the same time, at a micro level, you're driving competitiveness and other operating efficiencies. So with all of that together, as India is on its journey from $5 trillion to hopefully $30 trillion by 2047, in the Viksit Bharat plan, how will DIPAM ensure, and what kind of monetization should we expect between now and then? What kind of monetization should we expect between now and then to reflect these changes?
Very good last question. Our Prime Minister's dream of Viksit Bharat cannot be realized unless all of us partake in it with complete zeal, with entire force and enthusiasm. And our capital markets have to play a very important role in that. And the way we achieved financial inclusion, the way we brought in efficient redistribution, in the same way going forward, we have to enable our markets to become part of every Indian's dream, every Indian's saving and investment, every household's income, consumption, saving and investment. We have to ensure every Indian partakes in this dream. And this cannot be done by any one of us alone. We should all work together to make this happen and to make Bharat Viksit by 2047.
Thank you for that.
We are all hungry for more, so I won't come between the lunch and you. Dr. Chawla, thank you for coming down all the way from Delhi to Bombay despite the weather condition, etc. We were really worried until yesterday whether you would be able to make it. You took early morning flight and came here, but thank you, really appreciate. All the points which you made resonates with us as a practitioners of the capital market. Our mutual fund industry, as you rightly mentioned, has clearly played as a counter role to FIIs. Acronym, I'm not going to be using it, what you said, but they have genuinely played an important role here. Our mutual fund industry has become almost $900 billion, soon to touch $1 trillion, almost 30% of the banking sector. REITs in which itself is 100 billion now. The 100 billion of assets has gone to REITs in which. So these are the local products, domestic products, I should say, we are developing in the domestic market. That will go a long way to help some of your initiatives of the government, public sector enterprises restructuring as well. Once again, thank you for exceeding our request and coming here. We at FICCI, we are working hard to build this rapport between the industry and the policymaker and the regulator. In the series, your presence here means a lot to us. So thank you very much once again. And thank you everyone for participating. We break for lunch now.
Thank you once again, sir. And like Mr. Sangai mentioned, we'll quickly break for lunch and we'll reassemble back at 2 o'clock. We'll see you very shortly.